Hello, over the peak. It is Thursday's World Economic News. Will start with the Federal Open Mouth Committee. Ben and the boys have spoken. I had an idea to read the entire thing to you, but I thought that was a bit cruel. It's not very long, but I've just done it and picked out some bits. From yesterday, of course, or August the 9th anyway. Information received since the Federal Open Market Committee met in June indicates that economic growth so far this year has been considerably slower than the committee had expected. Down at the bottom, longer-term inflation expectations have remained stable. The committee now expects a somewhat slower pace of recovery over the coming quarters than it did at the time of the previous meeting. Moreover, downside risks to the economic outlook have increased. The committee decided today to keep the target range for the federal funds rate at 0 to 0.25%. And likely to warrant exceptionally low levels for the federal funds rate at least through mid-2013. The committee also maintain its existing policy of reinvesting principal payments from its securities holdings. Securities holdings, reinvesting its principal payments. Okay, the Fed makes money from nowhere, buys from the real world a treasury and puts it on its books. It'll take the interest when the interest is due, but when the principal payment is due at the end of the term of that bond, we'll call them all bonds, it says to the treasury, time to pay me. Treasury transfers money to the Fed, and then the Fed will reinvest that in different types of bonds or whatever it wants to invest it in. But it wants that ability to have the principal payment paid to it, so it's got the ability to keep spending money on things it wants to spend money on. Right, this next chart here from a different source is maturity structure of the Fed's Treasury holdings. This is what the Fed is holding at the moment, and these are in billions of US dollars. The tallest one is the over 1 year to 5 year Treasury bonds, $700 billion worth. So I think what they'll probably do with the other announcement there, that they're going to keep the federal funds rate at basically 0 until mid-2013. That means that at least for the next 2 years, if you're holding a 2-year bond, then you'll be able to know that the rate isn't going to be hiked on you and make the value of that bond go down. So it'll be safe to hold the short-term bonds, so the Fed won't have to do anything to hold those bonds down in interest rate. So they can, as they mature, they will get the money for those short-term bonds and probably invest them up on the right-hand side of that in the over 10-year and make that over 10-year bar go upwards. That will be to keep down the long end of the Treasury curve. And the idea would be to keep mortgage rates as low as possible. So we're saved. Marvellous. Economic Confidence Index by week. This is a Gallup poll for the United States. People. The dark green line was last year, boring 2010. But this is May, June and July, and coming into August there. 2010 was about flat, but you can see a nasty little turn down from early July. The last month has been a very large lack of confidence in the US economic people. Minus 553, nasty. Still, they'll be a lot cheered by the Fed's Open Mouth Committee's announcements. This is a tricky chart, this next one. this one, number 4. Are you there? Okay, the green is average consumer credit growth. Credit growth for the consumer. Are you a consumer in the United States? Well, this is your credit increasing or decreasing in green. And I'll call it red. The red one is retail sales. Now, over on the left of the chart, the idea is that look right in there's a real tall one in the middle of the left-hand block. And as it goes up, as consumer credit increases, it pulls up the retail sales, And this goes along until the recession, which is highlighted in red there. There's a red box where the consumer credit goes down, obviously, and retail sales go down. Whoosh. And that was our Great Recession type thing. So Daniel Alpert, who put this together, just to the right of the double ended arrow for QE1, he's put a couple of circles on the red pointing down towards the consumer credit growth in green. The idea being that coming out of the Great Recession, there was an increase in consumer credit growth which pushed up the retail sales, and then it dropped down again. And then it had another go, more credit growth, and it pushed up retail sales, but it flopped down again. And now we've got this great run-up in consumer credit growth from the bottom there, running all the way up to the top side, and increasing positive consumer credit growth, which did make the average retail sales growth go up to a certain extent, but now they've swapped over. Retail sales are going down, but consumer credit growth is still going up. Now, what Danny says about this is this means that consumer credit growth now is not to buy things, it's just enough to get by. They're actually borrowing money to pay for things they've already bought, if you see what I mean. They're just taking on credit not to buy new things, but to pay for things that bills that are coming due. And obviously that will lead to a recession, because you can't go on like that. Enough. Okay. Staying in America, but moving to a slightly different subject. Utilities announce coal plant closures. Now, in yellow I've done electric utilities have announced the closure of dozens of coal-fired power plants, totaling thousands of megawatts of capacity, in response to 2 recent power plant emissions regulations from the US Environmental Protection Agency, the EPA. Now, I've just put this in to say that if everything was going to be booming and the future was going to be marvellous, this would be a wonderful thing to behold. But I think that this is actually a mistake, and I hope they're just mothballing these plants and they'll be able to put them back online again, because I think further down the road these coal-fired plants will be needed again. Right. Over onto the European side of the Atlantic, and the bullets yet to be fired to stop the crisis by Ken Rogoff. So the wonderful American has come to Europe to tell the Europeans how to do things. And I've pulled this one paragraph from his Financial Times article. The most direct remedy, of course, would be to find expeditious approaches to cleaning up balance sheets whilst maintaining the integrity of the financial system. In other words, how can the consumers be tidied up, the household consumers be tidied up without blowing the banks up? In the case of Europe, this involves very large debt write-downs in the smaller periphery countries. Now, I'll read it. Combined with a German guarantee of central government debt in the rest. In return, Germany will have to receive a disproportionate share of fiscal power in a more deeply integrated union, for at least as long as it is making substantial transfers. Now, I think this is a mashup of a paragraph, but now we're in Europe saying that The only way of pushing forward in Europe is for Germany to bail out everybody that needs bailing out, and while it is doing so, it is put in effective charge of the economies of all the peripheries that it is bailing out. In the case of the US policy makers need to offer schemes to write down underwater mortgages, perhaps in return for other concessions, such as giving the lender a share of any future home price appreciation. And I hope you've got the idea that the mashup of this paragraph, that now we've hopped back to the United States and said the underwater borrowers need to have their mortgages written down, but the banks to be compensated by, when things do flourish in the future, the bank then will recap their losses by being able to have for themselves any rise in home prices that have accrued. So that's a hell of a paragraph, but I'll just point out in the middle, combined with a German guarantee of central government debt in the rest, in return Germany will have to receive a disproportionate share of fiscal power. That's a dangerous thing to be writing. Does Germany want a disproportionate share of fiscal power? It's an important point. Would they want it? Obviously they'd demand it if they were doing the bulk of the bailing out, but would they want it? And would the people bailing out want Germany to have disproportionate fiscal power over their countries? Anyway, a mashup of a paragraph, but in a way I quite liked it because it does point us towards the fact that this is an intermingled crisis. The crisis is basically a banking crisis that has fallen upon countries. A banking crisis that's fallen on sovereigns, and the sovereigns are struggling to hold the banking crisis together. And in a Telegraph article we get Stephen Jen, head of SLJ Macro Partners and former IMF official, said, Europe is replicating mistakes made by financial authorities after the Lehman crisis, when good banks were merged with bad banks, as with Lloyds and HBOS. This time the destructive fission is taking place between solvent and insolvent states. Investors are taking flight before the fission turns explosive. And this kind of makes the point I'm making. It's a banking crisis falling onto sovereigns, and the sovereigns being pushed into desperate measures to just hold themselves up, and the smaller sovereigns are falling back on the bigger sovereigns. Mr. Jen said Standard & Poor's downgrade of the US will have a knock-on effect for Europe, since the rating agency will have to apply the same logic. Understandable. And we move on to this Financial Times graph, which shows 5-year sovereign CDS credit default swaps, insurance that you can take out on the eventuality of a sovereign default on 5-year sovereign debt for two countries, in this case Germany and the UK. Germany in black and the UK in blue, and you can see that the German CDS insurance now costs more than UK sovereign insurance for 5-year debt. And that is because the market is now taking into account that Germany is being lent upon by multitudes of crippled peripheral countries. And that's it. It's tricky, isn't it? Bye.